Hello everyone, welcome back to our weekly webinar series. My name is Faida Hashmi. I'm the tax director here at Kress Cooper. Today I've been joined by my colleague Mahar Afzal and together we will be taking you through today's webinar. So the topic of today is the Free Zone Person's Guide. So this Free Zone Person Guide has come out day before yesterday. It is a long-awaited guide which people have been waiting for. Since the consultation paper for the Free Zone had come out, people expected the guide would follow shortly, but there has been a lot of wait. But lot of things which did not get answered from the last revised cabinet and ministerial decision that had come out. They have been answered now in this in the free zone persons guide. So we will be taking you through some of those today. Now, for any one of you who have joined us today who have don't have the basic knowledge of the free zone or what was in the circulars or in the consultation paper, we would advise you to see our previous webinars we had done on the application of provisions of corporate tax on the free zone, the cabinet decision that had came out, the free zone consultation paper, then the revised free zone decision that had come out. They're available at our YouTube channel with the handle Kress Cooper. If you have any questions, feel free to ask us. So this webinar will be a more detailed webinar. So if you want to see the basic concept first, please visit our YouTube channel. Now we will be discussing the free zone person guide. So the free zone person guide is applicable on free zone person. Now what is a free zone person? So the law says that any juridical person who is incorporated, established, or otherwise registered in a free zone, that including a branch of a non-resident person, is a free zone person. Now two conditions we can see from here. One, that you need to be registered in a free zone. So anybody who has to be classified as a free zone person needs to be in the free zone first. Then it can only juridical persons can be a free zone person. That means natural persons, they cannot be free zone person. Juridical persons are basically those who have a separate legal identity, and those juridical persons like LLC companies, public joint stock companies, or incorporated partnership, those that are incorporated or registered inside a free zone, only those can be considered as a free zone person. Now, if you are registered outside of the free zone, but you are being effectively managed and controlled with within from the free zone, so that is where your place of effective management is still, you will not be considered as a free zone person. So just because of this effective management and control would not make the basis of that you are a free zone person. You will still not be a free zone person till you are actually meeting the condition that you are registered inside a free zone. So free zone person, so either there can be two ways. One, you can either be registered yourself inside a free zone and then you are the head office in the free zone and then you have branches outside of the free zone. Or you might have an head office outside of the free zone, maybe inside UAE or maybe in some other country, and then you might have branches inside the free zone. So, for example, in this case, if your head office is in UAE, then it will be called as a domestic permanent establishment. If your head office is in some other country outside of UAE, it will be called as a foreign establishment, permanent establishment. So, in either scenario, this 0% corporate tax rate, which is being given to as a in advantage to the free zone person, to the qualifying free zone person, it will only be for the free zone business and not for the other business. So it will only be applicable on the portion of the business that is registered in the free zone. So only they can enjoy this 0% tax rate, and it will not be applicable on the domestic permanent establishment or the foreign permanent establishment, as the case may be. Now, when the law came out, they said that qualifying free zone persons would be the ones eligible for this 0% corporate tax rate, and some conditions were given. So, in the law, the conditions that were given were that the qualifying free zone person should maintain adequate substance in the free zone. It should be driving qualifying income. It should not elect to be subject to corporate tax at the standard rate, and it should comply with the arm's length principle and transfer pricing rules and documentation requirement. Then later we saw that ministerial decision had come out on the free zone, and in that they had given two more conditions in that decision. One was that the non-qualifying revenue should not exceed the de minimis requirement. So there is a de minimis threshold that is being given. We will be discussing it in the later slides. So this threshold should not be exceeded. That is one of the conditions. And then qualifying free zone person need to prepare audited financial statements. So we know that a regular company needs to be preparing an audited financial statement if the revenue is exceeding 50 million. So in this case, even if there is no revenue, generated out of this free zone person, they still need to have audited financial statement. So all these six conditions, the four that had came out earlier in the law, and then the two that had come out from the cabinet decision, these conditions, six conditions need to be met for a qualifying free zone, for a free zone person to be able to be a qualifying free zone person. So let's discuss some of these in detail. So one of the condition is to drive qualifying income. So when we say qualifying income, we mean that any transaction which either the company, the free zone company, is doing with another free zone company, the condition is that that free zone company should be the beneficial recipient of the transaction. What is a beneficial recipient? It means a person who has the right to use and enjoy the service, and does not have a contractual legal obligation to supply such service or good to another person. So it has to be for their free zone business. They cannot be buying from a free zone person and then attributing that to their mainland entities or selling it further to someone else. So this obligation to ensure that the transactions are being done to beneficial recipient, this will lie with the supplier. So basically, either you will have to build this clause into your contracts, or either take an undertaking from the company that they are the beneficial recipient of this service or this transaction, so that then this will be able to be qualified as a qualifying income. The other is that the transaction that you're doing with the free zone person, it should not be one that is included in the excluded activities. So Mahar will be discussing it in detail, what are excluded activities. But for example, transaction with natural person, in most cases, they are part of excluded activities. So it should not be one of those, or any transaction which is relating to immovable property, which is located outside the free zone, or any non-commercial property, that is like residential property, which is located in a free zone. Then qualifying income is also any transaction which the free zone person is doing with someone who is not a free zone person, but they are part of the qualifying activities. That can be part of the qualifying income. Again, the qualifying activities, there are certain activities provided in the law which are part of a qualifying activity, which Mahar will be discussing in detail. So if we are undertaking one of those activity with a non-free zone person, and they are not activities which are part of the excluded activities list, so they are part of the qualifying income. So any income which is derived from the ownership or exploitation of qualifying intellectual property, or there is a small portion of income, like we had discussed before, that there's a de minimis requirement that should not be breached. So if we are within the de minimis requirement, so any other income which might not be qualifying income, that would also be considered as qualifying income. So this condition, first condition being that the qualifying free zone person needs to be driving this qualifying income. The second condition being that they need to have adequate substance in the free zone. So this adequate substance was explained in the cabinet decision, and that clarified that the core income generating activities of the free zone person, which are basically the essential and the value adding activities, that need to be performed in the free zone. Or for example, if certain qualifying activities have different conditions, for example, distribution of goods have a condition that you need to be in a designated zone. In that case, you need to have this adequate substance in a designated zone, not only in the free zone. So you need to have adequate assets, adequate number of qualified employees, and you need to incur adequate numbers of operating activities in the free zone or in the designated zone, as the case may be, depending on what qualifying activity you are undertaking. Now, you're allowed to outsource this activities, but only to a related party or a third party inside the free zone, and you need to have adequate supervision. The only exception is for qualifying intellectual property, where this core income generating activities can be outsourced to somebody in UAE, in the mainland, or to someone who's not a related party, to a third party outside of the UAE. So it can be in a foreign jurisdiction also, but this is only applicable for qualifying intellectual properties case and not for any other activity. For that, you need to be in the free zone uh, or in a designated zone, as the case may be. Then we have the condition that you need to comply with the transfer pricing rules. So first of all, you need to comply with the arm length principle. So there needs the transaction between the free zone parent. So free zone parent basically refers to the free zone company, and foreign permanent establishment. Like we said, that if their head office is in foreign jurisdiction, or if it is in UAE, then it's a domestic permanent establishment. So basically, any transaction between them, they need to be at arm's length. Also, if there are any documentation requirements, so if you are meeting the condition to maintain a master file or to maintain a local file, then this needs to be also complied with. Now, if the free zone person has income that is subject to 9% corporate tax, for example, any income which is being attributable to the foreign permanent establishment or domestic permanent establishment, then you need to have this records or supporting document to demonstrate how this profit has been attributable. So now, how have you allocated this profit to those domestic or foreign permanent establishment or and to the free zone parent? So how has this allocation been made? You need to have documentation to then satisfy FTA later on how this has been done on arm's length. Another requirement is the de minimis requirement, so we should not be breaching the de minimis requirement. So what happens is in the law, they have allowed that a certain level of income you can earn, which is not generating qualifying income. So rather than being strict and saying that if you earn any income which is not part of qualifying income, you will not be meeting the condition. They have allowed a small portion to be, that if you are not exceeding that threshold, then it is fine, and that non-qualifying income will also be considered as qualifying income. So, what is that de minimis threshold? It is 5% of the total revenue or 5 million, whichever is lower. So, whichever is lower of these two, that is your threshold, and that needs to be maintained. So, the income which is non-qualifying needs to be under this threshold, and so then it can still qualify as being qualifying income. Now, what is this non-qualifying income? Like we talked about, it can be income from this excluded activities. It can be activities where they're not qualifying activities, and the transaction we are doing with is with a non-free zone person. So, like we had discussed, that if you are doing transacting with a with a free zone person, then you only need to see that it's not part of the excluded activities, and that there's a beneficial recipient who is the one getting this. You're doing this transaction with. So in that case, if it's a non-free zone person, then you will have to see that it is part of the qualifying activities, which Mahar will be discussing in detail, and they're not excluded activities. So basically, excluded activities are going to be excluded, and if they need to be part of the qualifying activity and they need to meet the conditions of those qualifying activities. For example, we just discussed that for distribution of goods, there are certain conditions. For example, you need to be in a designated zone. The customers of yours that you are supplying trading this good to, selling this good to, they need to be wholesaler, retailers, and not end user. So whatever the conditions are of that qualifying activity, that needs to be met as well. So otherwise, it will be part of the non-qualifying activity. So when the free zone person is now doing this calculation, and revenue from some of the income is not calculated when we are doing this calculation, which those are those that are subject to 9% corporate tax straight away. And so these four that are mentioned here, the income which is attributable to the foreign permanent establishment or to domestic permanent establishment, income from immovable property other than the commercial property which is located in the free zone, and if you are transacting with free zone person, and income from ownership and or exploitation of intellectual property other than the qualifying income from this qualifying intellectual property. So these four incomes are straight away taxed at 9%. They are not they are not part of the de minimis calculation. So if you are earning one of these, they will not be part of this threshold of 5 million or 5% of total revenue. You can exclude them and then check. So one example, if a free zone person is driving revenue of 10 million, of which 2 million is attributable to the domestic permanent establishment, then the total revenue for the purpose of the calculation would be 8 million, and this 2 million will not be considered. This will be taxed straight away at 9%. Now, some of the other conditions, like we had discussed, that the audited financial statement needs to be there even if no revenue is being earned. And then you should not you should not elect to be taxed at the standard rate. Now, why would somebody want to be taxed at the standard rate? Could be that they want to be part of a tax group because qualifying free zone person cannot be part of a tax group, or they want to avail the small business relief, which is not available for qualifying free zone person, or they might be seeing some other benefit of being taxed at 9%. So if they have elected for that, or if they are not meeting these six conditions which we just discussed, then they will, beginning from the period where they have made this election, or they have stopped, meeting this criteria, failed to meet this criteria, they will not be a qualifying free zone person for that year and for the next 4 years. So, for example, if they stop meeting the criteria or elected to be subject to corporate tax rate in 2024, then for the next 4 year till 2028, they will not be able to be a qualifying free zone person. Now, in 2029, they will again see if they are meeting this condition afresh. So if, for example, they were not meeting the condition in 2027 or 2028, it will not, have any bearing to them being a qualifying free zone person in 2029. They need to see everything again, that if they're meeting those six conditions, and if they want to make an election again, then it has to be a fresh election again. So if they made an election in 2024, they need to again make an election in 2029 for that. Now, what are the rate that is applicable to a qualifying free zone person? So on this qualifying income, if they're meeting the condition, 0% would be the rate, and then 9% would be the rate on the non-qualifying income. Now, the benefit which a normal entity, who's not a qualifying free zone person, of the 375,000 threshold that they have, that 0% is up to 375, and then 9% on whatever is over it, that is not available to a qualifying free zone person, and 9% straight away will be the rate on any income, even if it is below 375,000, even if the non-qualifying income is below this threshold. Now, we need to be careful that when we say a free zone person, obviously the free zone company will be registered with one of the free zones in the UAE. So some of the free zones, they have a deadline. You can say they have been given a tax incentive period. So if that tax incentive period finishes, for example, if one of the free zone only has the free zone incentive till, let's say, 2029. So once 2029 comes, then in 2020, then later after that, a qualifying free zone person who is situated in that free zone, who has, the incentive period is finished for them, they will not be able to be a qualifying free zone person. So it is very important to know that if there is a deadline or there is a, timeline for this tax incentive period for any free zone person. So yeah, that is it from me, and I will hand it over to Mahar, who will now be taking you through qualifying activities and also excluded activities.
Thank you very much, Faiza, and thank you very much, everyone, for being with us today. So we are discussing today free zone person's guide. I think you all will be aware of this. What are the conditions for a free zone person? What are the qualifying free zone person? What are the 6 conditions that a person can be classified as a qualifying free zone person? What are the benefits available to the qualifying free zone person? And today we'll going through the qualifying income of the qualifying free zone person. Along with this, we'll be discussing the excluded activities, qualifying activities. That then we'll be quickly going through the guide as well. Very honestly, the time is not sufficient to discuss the guide because the guide is around 135 pages. But still, we'll try to go through the key areas. We'll have one more session on the guide as well. So just look into this diagram, which is a very important thing. If we're asking what is the total income of the qualifying free zone person, the total income of the total income of the qualifying free zone person, total revenue of the qualifying free zone person can be classified into the exempt revenue, or it can be classified into the taxable revenue. Here is the exempt revenue, here is the tax revenue. This exempt revenue will be treated exactly as per the general rules of the corporate tax. What is the total revenue? This total revenue can be further classified into 2 categories. One category, the revenue will be straightforward subject to tax at 9%. This revenue is income from the domestic P. We know this, what is domestic P, income from the foreign P, income from the immovable property, except one stream of income from the commercial property, which is 0 rated. Otherwise, all income of the immovable property will be subject to tax at 9%. Then 4th category is qualifying income of the intellectual property, except the qualifying income of the qualifying intellectual property. Means if we are getting any income from the intellectual property other than qualifying income of the intellectual property, that will be straightforward subject to tax at 9%. So taxable income, these four income will be straightforward subject to tax. The rest will be the remaining income which will be not be subject to 9% tax. This revenue can be classified non-qualifying revenue, and this revenue can be classified as a qualifying revenue. The non-qualifying revenue includes income from the excluded activity. We will discuss the excluded activities as well. Income from the free zone person, which is not the beneficial recipient, and non-qualifying activity with a non-free zone person. These three categories can be classified as a non-qualifying revenue. If any of the revenue out of these three revenues pertains to this 9% revenue, the revenue first we classified under the 9% revenue, then it will be classified as a non-qualifying income. Remaining will be qualifying income, and qualifying income is income from the qualifying free zone person, except that student activities and all these things. You can go through this. The important thing is whenever we are applying the de minimis criteria, the law says we need to consider the non-qualifying revenue divided by the total revenue. They are considering this area basically. This is the non-qualifying revenue and total revenue. We should not consider this revenue. We should not consider this revenue. We should not consider this revenue. We need to consider the non-qualifying revenue. This revenue of the qualifying free zone person, it will be the nominator. This will be other revenue, it will be the denominator. This percentage, if the percentage is less than 5%, or 5 million, whichever is lower, then it will be considered that the qualifying free zone person has not met the criteria of being a qualifying free zone person. So in this category, the important thing is we can classify the whole income of the qualifying free zone person into four categories. And how can we apply the de minimis test? Now, based upon this criteria, what will be the remaining income? That will be a qualified income of the qualifying free zone person, which will be subject to tax at 0%. So the qualifying income will be income derived. Basically, we are discussing this box only here on the next slide. What is the qualifying income of the qualifying free zone person? Income derived from the other free zone person, except income from the excluded activities, income derived from qualifying intellectual property, qualifying income of the qualifying intellectual property, income derived from the non-free zone person from the qualifying activity, income derived from the commercial property, but this commercial property is being used for business purposes. This is within the free zone. Transaction is being made with the other free zone person. A lot of conditions related to this. Then this income will be considered a qualifying income, and the loss will be income where the de minimis criteria is not being met. These are the five categories of the income which will be considered qualifying income. If the de minimis criteria is not being met, then in the current period and the next 4 years, you will not be able to enjoy the qualifying, basically qualifying a 0% income relief. Just look into this example. This is how I mapped the example number 5 of the guide. If you are going to the example number 5 of the guide, if we are going to the example number 5 of the guide, I have mapped the example number 5 into this. These all things you have already go through. This is the example number 5 of the guide. They said from a domestic P 10 million, from the rental immobiliar property is 2.5 million. This is basically income transaction with the other free zone person, for other free zone person, which to relate to the excluded activity. This, if we are considering this total, the total income, then this is, if you are going, this is a 10 million, 2.5 million, 5 million. If you are mapping the exact same example into this diagram, you will find the total revenue of the person is 19.8 million. Zero is the exempt income. Total taxable revenue is 9.5 million because exempt income is zero, to taxable income is 19.8 million, which is subject to tax. This is 10 million and 2.5 million. This 10 million and 2.5 million is 12.5 million is the income which is straightforward subject to tax. Remaining is 7.3 million. This 7.3 million of the income, this is the non-qualifying income. This is the non-qualifying income, which is income from the excluded activities and income non-qualifying activities of the income that is being generated from the non-free zone person. Remaining is the qualifying revenue. Now, if you are considering what is the percentage of the non-qualifying income, we can say, which is required for the de minimis criteria, you will be able to find in the example they have put it. These two revenue, point 2 and point 3, non-qualifying revenue divided by 7.3 million, which is exactly 6.67 million. We can say the criteria has not been met for the de minimis, and the person cannot consider a qualifying free zone person. In the same example, they have given the next example, example 6. In the example 6, they ask this 0.3 million revenue, they have classified from the non-qualifying activities to the income generated from the domestic PE. Means this year has been increased to 10.3 million. Once it has gone to 10.3 million, you can see on the next slide, this has gone to 10.3 million. This income has been reduced from 7.3 million to 7 million. This income is as it is, the percentage is 2.85%. So this is the de minimis important. This is the highly complex area. Honestly, I have already personally spent a lot of time on this, how to structure this revenue into a different category, which will make more convenient for the people who are sitting in the industry, or who the whatever the people who are the beneficiary, basically how to classify the income. That will be quite helpful. So if you are plotting these boxes and you are putting the income in the respective area, you just need to go through the income and you need to plot it in the respective area. Then you will be able to apply the de minimis criteria. You will be able to assess which income will be subject to tax at 9%. You will be assessed which income will be zero rated, which income will be considered normal income. So all these things you can find in these boxes. So this is the first thing where we can say what is the qualifying income. Now I believe we all are very clear what is the qualifying income. Next, qualifying income, what is the criteria? Basically, I will not go through this in detail. I think we have already discussed multiple times. If the qualifying free zone person is generating income from the other free zone person, then it will be considered qualifying income. If the qualifying free zone person zone, we have while discussing this, we have classified the whole world into the 4 category. Basically, this person who is a qualifying free zone person can generate income from the other free zone person, from the same free zone, other free zone person in the other free zone, then from the mainland, from the rest of the whole world. Then the law says basically if this is a qualifying free zone person, which will be for sure based in the free zone, it will be a juridical person. If this person is generating any income from the other free zone person, which is not excluded activity, which is not the income which is subject to tax at 9%, that it will be zero rated. Other free zone, same criteria is applicable except the commercial property. If they are generating any income from the mainland, or basically they are asking qualifying activity from non-free zone person, that will be subject to tax at 0%. So this thing we have already discussed. This is the commercial property we have already discussed. When the commercial property income can be classified, this is only one stream of income, only one stream where the income from the immovable property, commercial property, can be classified as zero rated. In all other cases, it will be subject to tax at 9%. So this is the one stream, and this one stream is basically only one situation, one possibility. Then this one possibility is that person is a qualifying free zone person. Property is in the free zone. Transaction has been made with the other free zone person. Property is a commercial property that is being used for business purposes. Property is being used exclusively for business purposes. If all these conditions are being satisfied, then any income generated from the commercial property will be considered as a qualifying income as well. Otherwise, it will be straightforward subject to tax at 9%. Now we discuss this is a qualifying income from the qualifying intellectual property. If I mean intellectual property can be classified into qualifying intellectual property or non-qualifying intellectual property. If this is the non-qualifying intellectual property, it will not fall under it. This property, non-qualifying intellectual property, will not generate qualifying income. Only the qualifying intellectual property will generate the qualifying income. Whatever the income this qualifying intellectual property is generating, some portion of that income will be qualifying income and some portion will not be a qualifying income. We'll look into the formula. They have given a specific formula for this, which portion, how much will be the qualifying income. Qualifying income of the qualifying intellectual property will be zero rated. Non-qualifying income will be straightforward subject to tax. So what is the qualifying income? They have given a specific formula for this. We will discuss in this. Qualifying intellectual property, they are asking, this is a registered patent, trademark, which are registered, legally protected, but these trademark, intellectual property and tangible assets are not being used for the business purposes. This is a specific formula to calculate the qualifying income of the qualifying intellectual property, total income from the qualifying intellectual property divided by multiply with the qualifying expenditure plus uplift expenditure divided by the overall expenditure. This formula will give me how much percentage we will discuss in the guide as well. So this is the formula to calculate the qualifying income of the qualifying intellectual property. Now coming back to the excluded activities. In the guide, they have given further clarification on the excluded activities. By the way, no one has any doubt about the excluded activities category. Everybody was very clear that what type of transaction are excluded to be qualified as a qualifying activity or to generate the qualifying income. Transaction with the natural person, exceptions are same. That is being given here. Banking business is same. Insurance, except this is the same. I think this is what I'm trying to say. Basically, in the guide, there was none of the point was there where the people are asking some sort of clarification from the FTA. I think everyone very clear regarding this. In the guide, they have just given in detail examples. An important thing they said in the guide is basically from end to end process we'll discuss in the guide, from the start point planning to the end. Whatever the activities will be considered ancillary activities, so it will be having the same treatment like the main apparent activity. Now these are now coming back to the qualifying activities. Yes, we will be seeking some sort of clarification from the FT on the qualifying activities. Those we'll discuss in detail. Manufacturing, they have given further detail on this. I think everybody is already clear. We'll discuss processing of the good, qualifying income of the qualifying commodity, hedge holding, ownership. They have further clarified it. That is very good. Reinsurance is fine. Fund management, wealth management, headquarter services related party, treasury and financing and leasing of aircraft distribution, which is the most important thing that we were all was seeking some sort of clarification on the FTA, but they have stick to the public consultation paper. Basically, third port sale will be considered as a qualifying activity and generate qualifying income. Even the goods are not coming into the view. We will discuss this logistics, services, and ancillary activities. We'll discuss all these things in our guide without wasting further time on this slide because we have already discussed the same thing multiple times in the past. Now I'm going straight forward to the guide and we'll discuss the guide. In the guide, some of the portion I will go through very quickly. Rest of the portion we can discuss in detail. Okay, free zone corporate tax rules. We know the rules. Conditions to be a qualifying free business partner. We know there are 6 conditions, and Ms. Feda, she has already discussed in detail what are the 6 conditions are there. Nothing is unusual. All those 6 conditions are applicable. Then taxable person must have qualifying income. We know we already discussed the qualifying income. There are 5 categories of the qualifying income. These income are subject to tax straightforward at 9%. This income, okay, this income will be straightforward subject to tax at 9%. This is the basically my qualifying income. We already discussed this income will be straightforward subject to tax at 9%. This income will not be considered while applying the de minimis formula. It will not be in the numerator, it will not be in the denominator. All the transactions should be the arm's length principle. This is one of the conditions to be a qualifying free person. Then qualifying for reason must make transfer pricing documentation. We have already discussed this. Transfer pricing documentation should be there. Must maintain audited financials. Audited financial statement compulsory. It doesn't matter whatever the level of revenue. But preparation of the financial statement, either you are applying cash basis of accounting, full-fledged IFRS for SME, it all depends upon the revenue in which category you are falling. If your revenue is More than 50 million, then you need to apply the full-fledged IFRS. If your revenue is less than 50 million, then you can apply for IFRS for SMEs. This is all in your hand, but important thing is that whenever what are the criteria that you are applying, audited financial statement to have the financial statement audited. This is compulsory. It doesn't matter whatever the level of revenue, but you can apply the accounting policies as per discretion. But this discretion is not applicable if revenue is more than 50 million. So non-qualifying revenue, we have already discussed. The non-qualified revenue discussed in the slide is the same thing. This is an example basically. Taxation of a qualifying free zone person. Important thing is to determine taxable income. Not qualifying the free zone person should apply the standard corporate tax rules. Yes, agreed. To an income, this is exempt basically. If your income is exempt, general rule will be applicable. Otherwise, 375% exemption is not applicable, because usually to taxable person income up to 375,000 is 0%, then 9% tax will be applicable. In case of qualifying free zone person, straightforward tax will be 0% and 9%. There no exemption of 375,000. Losing status of qualifying free zone person. If you're losing the status, you cannot become again a qualifying free zone person in the current period, next 4 period. Important thing is here that by default, the free zone person will be assumed that they are the qualifying free zone person. Then if you don't want to be a qualifying free zone person, because if you are qualifying free zone person, relief will not be available. Small business relief will not be available. Other reliefs will not be available. If you wanted to become a qualifying free zone person, then you will have to apply to the FTA to become a taxable person. Otherwise, by default, you will be assumed that you are a qualifying free zone person. Requirement to become a qualifying person, being a free zone person. Okay, juridical person should be a juridical person. Scope of the corporate tax law, we have already discussed this. Transaction, beneficial recipient is important. At the person at the end should be, if the goods or services are being provided to the other free zone person, that person should be a beneficial recipient. It should not be agent. They have given this in detail. I think we have all had the same understanding. So they know as such difference. All the person, whoever is the beneficial recipient, it's fine. Then this qualifying income will generate. In this example, they have given that C is a free zone company. M has approached C for the services. C has approached D. C has outsourced the services to D. D is giving services to C. C is given to M. They are asking in this situation, C is the beneficial recipient. So then this is the criteria. Even the D is given the service. The reason is D doesn't have any contract directly with the M. So this is the example that they have given. De minimis criteria we have already discussed in detail. De minimis requirement, I already discussed the examples. Basically, this example we have already discussed. De minimis criteria, this is a very basic example. You can go through this basically. Attributable, how much is the attributable to the domestic P, how much is the attributable to the local P. This is not so anything. This table, in this table, almost I have basically translated somehow the same thing on a different slide. I've already shown it to you. I have some sort of concern about this no, because immovable property, if the property is immovable, as per our understanding, as per my understanding, that it should be a straightforward 0% or 9%. So if this should be like this for intellectual property, should be yes or no. It should have been for the intellectual property, yes or no. Yes, qualifying income. If this is a commercial property, transaction is being made with the other free zone person, property within the free zone, property is exclusively being used for business purposes, then it will generate qualifying income that will be zero rated. Other than this, every income of this immovable property, it should be subject to tax at 9%. So this income should not be considered while applying the de minimis formula. So whenever they are putting no here, means this will category here, it can be considered. This thing I need to look into. This rest everything is very clear. You can follow the slide that I already shared with you in my presentation. Exempt person, we have already discussed that income will be straightforward, not subject to tax. Example number 5, we've already discussed. Basically, this is the same thing I've already told you. This initially rate is coming 8.5%. Then they have removed 0.3 million. They have classified related to the P. Then this rate has come to 2.85, something like this. It was coming the result. Yeah, 2.86. So initially, it was not the qualifying free zone person. Once they have reshuffled the income, now they become a qualifying. This is how we can apply basically the de minimis criteria. Other criteria of the qualifying free zone person, adequate substance. Adequate substance, one thing is very important here. If you are in the distribution business, then the qualifying free zone person must have the adequate substance in the designated zone. If you are not in the distribution business, then you can maintain anything in any free zone person. Again, if the business is outsourcing, the SIGA core income generating activity, this SIGA needs to be outsourced in the free zone or in the designated zone as well, and it should be supervised. For the qualifying intellectual property, the guide as well as say very clearly the qualifying intellectual property, the activities, R&D activities, SIGA core income generating activities can be outsourced to free zone person, to any person within the UAE, or to any person other than a related party out of the UAE. This is the important thing that needs to be highlighted that I did it. Rest everything is very clear. Deriving qualifying income. So here they said basically if does not earn any qualifying income, you are not started. This basically is about the new business. You set up a new business, you're not derived any qualifying income, still you will be considered qualifying free zone person if you are maintaining the adequate substance, all other criteria is being met. As I already discussed, by default free zone person, free zone juridical free zone person, by default they will be assumed that they are the qualifying free zone person. If you set up a juridical person within the free zone, by default, you will be assumed that you are qualifying free zone person. If you are not, you will have to apply to the federal tax authority to become a taxable person. So by default, you will be assumed, they mention here as well, will not automatically disqualify company from being a qualifying free. By default, you will be a qualifying free zone person. They have a given arm length, you need to follow, we've already discussed. Transfer of documentation, election to be, now this is the election not to be qualifying for. By default, you are qualifying for reason person. You can make an application to the authority. Why will you make an application? Because some reliefs are not available, like qualifying free zone person cannot enjoy the small business. Qualifying free zone person cannot become a part of the tax group. They cannot become a qualifying group. So they cannot transfer the losses. Some of the reliefs are not available to the qualifying free zone person. When these reliefs are not available to the qualifying free zone person, qualified free zone person can make an application to the FTA to be considered a taxable person. And once you are making an application, this will be effective from the start of the tax period in which you have made an application and from the next 4 years. After 1 + 4 years, this will be expired and you will have to apply again that you wanted to remain a taxable person. This they are highlighted in this qualifying free zone person. You can go through the example as well. Election to be subject to standard corporate tax rules. Again, as I mentioned, you need to make new election after 1 + 4 years. Losing status as a qualifying free zone person. You can go through this. Calculating corporate tax for the free zone person. How will you calculate? We have already classified income, exempt income, income subject to tax at 9%, non-qualifying income, qualifying income. Exempt income, we need to exclude it, it will not be subject to tax. 4 categories: P, local domestic P, foreign P, income from the commercial property, except one stream of the commercial property. And fourth, income from the non-qualifying intellectual property or non-qualifying income of the qualifying intellectual property. It will be straightforward subject to tax at 9%. It will not be considered in the de minimis rule. We've already discussed this. So they have mentioned again, this is a qualifying income. You can go through this. This is the qualifying income. This is a income that will be straightforward subject to tax at 9%. Taxable income is not a qualifying income separate. Now the question is, now you have multiple income. You have exempt income, you have excluded activities, you have income subject to tax at 9%, you have qualifying income, you have non-qualifying income. Do you need to maintain a separate financial for this? The guide says, no, you are not liable to have a separate financial for this. You need to have one financial, but you can create the code in your system. Once you are creating the code, you can classify, okay, this income is straightforward subject to tax at 9%. This is exempt income. This is non-qualifying income. This is the qualifying income, because in case your audit is being opened tomorrow, down the line, 4, 5, 6, 7, after 10 years, you will have to provide this information to the federal tax authority. So you are not liable to maintain a separate financial, but you need to classify the income in your financial. This they yeah. And if you are classifying income, you need to apportion the expenses as well. Direct expenses needs to be allocated first. Then the residual common expenditure needs to be allocated based upon the appropriate basis. And the basis they have mentioned here, you can apply different basis based upon the functional analysis, how much asset, risk, and function performed by the respective function. Then you can allocate the expenses based upon this. They have given you the allocation keys here. You can go through the allocation key, like head count, floor space, usage. This is a very common thing. You can go through this. You can allocate the pro rata basis. So the crux is you are not liable to maintain the separate financial. One financial, you can create the code. Based upon the code, you can classify the income, common expenses. Okay, then you need to allocate the expenses. Directly allocated expenses, first trace the expenses, directly allocated expenses based upon the risk involved, function performed. Any common expenses, it should be allocated based upon the allocation key that they have given. It should be apportioned on pro rata basis. You can go through this. This is the example exactly pertain to all these things. You can go through this. Qualifying for reason person will not be able to enjoy this relief. We have already discussed this. Tax losses. This is important. Now the qualifying for reason person can have a tax losses as well. This loss, there is a possibility that this loss pertains to the taxable income component, exempt income component, or qualifying intellectual property, or a qualifying income component. Basically, various components are there. There is a possibility that you can make the losses. If the losses are there, asking you need to segregate the losses as well. So taxable income component losses will be adjusted against the taxable income component. Qualifying intellectual property losses will be adjusted against the qualifying intellectual property. And qualifying free zone cannot utilize any losses incurred prior to. This is very common. You cannot carry forward the losses before the registration or before becoming a taxable person or before the effective date of the corporate law. That they have covered in this, you can go through the example on this. Adequate substance, we have already discussed. You need to maintain the adequate substance, and there is a specific requirement for the qualifying intellectual property business, and where you can outsource it. While the distribution business, you need to be in the designated zone, and this adequate substance needs to be maintained throughout the period. You cannot have a double count of the head basically. What are your employees? You cannot double count. If one person is performing one function, they are asking, it will be considered that person is performing the same function, unless the person is devoting 2 hours to different activity, 3 hours to different activity, then you can allocate it. They have given it basically here the adequate substance examples. You can go through this. There are an adequate number of full-time qualified employees to having the qualifying activity. This is important here, that you need to maintain the adequate substance related to the related to the qualifying income. This is very important. If you have exempt income, if you have an income subject to tax at 9%, law is not asking you need to make the adequate substance for the exempt income within the free zone or within a designated zone. Or if you have an income which is subject to tax straightforward 9%, law is not asking you need to maintain the adequate substance within the free zone or designated zone. For law is asking you need to maintain the adequate substance for the qualifying income. So you need to be very careful on this. These are examples. You can go through this. Qualifying intellectual property we have already discussed. This can be outsourced to free zone person, to any other person within the UE, means any other person which is based in the mainland in the UAE, or to any other person which is not your related party out of the UAE, you can outsource it. But supervision is compulsory. You need to maintain track. What is the supervision? They have given in the guide that you need to sign an agreement, then you need to sign how will you monitor, then you need to closely monitor the activity. They should be reporting some sort of, they are given, you need to monitor properly what are they exactly doing, what they need to do. You need to supervise them properly, and this they have given in the guide as well. Outsource activity we have already discussed. This is the same thing that I discussed, conducted in the free zone person. Adequate supervision we have already discussed, just you can go through this. Foreign PE, foreign PE or domestic PE, we have already discussed. There is a possibility that mainland company has a branch within the designated zone or free zone company has a branch on the mainland or out of the UAE. So they will become basically PE. We know what is PE, fixed establishment, fixed place of business, or anyone who is exclusively working for the qualifying free zone person, it will be considered PE, permanent establishment. Once the PE is there, we have already discussed the income of the PE, even domestic PE, even foreign PE, it will be straightforward subject to tax at 9%. But in the law, it has been given for your foreign PE, you can apply to the FTA, you can ask that for the foreign PE, we will not consider the income of the foreign PE, we will not consider the expenses of the foreign PE, you can claim the exemption. But this is not applicable for the domestic PE. So in this section, you can show they have asked detailed briefly basic. What is the PE, fixed place or exclusive agent? Then income will be straightforward subject to tax at 9%. They have given it here. You can go through the example here. Then they said foreign PE may elect to take the income and associated expenditure. Just I have told you, you have an option to claim the exemption for the foreign PE. They have covered in the domestic PE, you cannot claim the exemption. It will be straightforward subject to tax at 9%. Fixed PE, yes, you can go fix up. This is the definition of the PE basically. Cases that are not considered a fixed PE. Basically, if there is a sports office of the free zone person on the mainland that is just providing them sports services, that it will not be considered PE. So they have defined in this, we have already discussed basically in a previous when we were discussing the PE, this is the same thing, no change basically. If there is a sport office, it will not be considered PE. Otherwise, it will be considered PE. They have put prepaid and auxiliary activities they have mentioned here as well. They have defined basically further. I can just give you the summary, and the crux is basically there is a possibility the free zone person has a branch on the mainland, there is a possibility vice versa. So for the local entity, when it will be PE, when there is a fixed establishment, branch, office, or any site for the construction or any exclusive agent on the mainland, it will be considered local PE. In the same way, it will become the foreign PE definition as well. Foreign PE, qualifying free zone person can claim the exemption. Local PE, they cannot claim the exemption. It will be straightforward subject to tax at 9%. When it will be PE, so any sport services provided by the office from the domestic company, like I just wanted to give you an example. They have given in the guide as well that if you are a business within the designated zone, you have a company on the mainland company just doing the marketing on your behalf. It means they are providing a sport services. So it will not be considered PE. So that PE will be straightforward. If the PE income will be straightforward subject to tax at 9%. If not PE, then it will fall. Then we need to look into this. If this income is being generated from the qualifying activities or non-qualifying activities. Immovable property, we have already discussed. Only one stream of income is there, which will be qualifying income. All income other than this, it will be straightforward subject to tax at 9%. So they have given this here. This is a commercial property. This portion of income will generate the qualifying income. This is a commercial property. It will not generate qualifying income. It will be straightforward subject to tax 9%. This is residential property, straightforward subject to tax at 9%. We have already discussed one stream of income. There's the only possibility that qualifying free zone person is making any transaction with the other free zone person related to the commercial property, which is in the free zone, which is being used exclusively for business purposes, then it will be qualifying income. Otherwise, it will be straightforward subject to tax at 9%. It doesn't matter either this is in the free zone or out of the free zone. They have given example. This is the qualifying free zone person. Income generated from the non-free zone 9%. Income generated from the free zone person, commercial property exclusively being used for business purposes, qualifying income 0%. Qualifying free zone person, income generated from the non-free zone person 9%. Non-commercial property, hotel straightforward subject to tax at 9%. This is what we discussed earlier as well. Nothing. If this is there is a possibility, this property from which you are generating the qualifying income, there is a possibility this property is a commercial property which qualifies for the qualifying income, or other than this, then you need to apportion the expenses as well. You can take the square feet or any other appropriate allocation key. Based upon this, you can allocate your expenses. Intellectual property. What is intellectual property? Patent, copyright, legally registered as required under the UE law or other international law. Why this exemption has been given? Because they wanted to promote, government wanted to promote that the people needs to invest in the R&D activity for the intellectual property to develop the app, to develop the patent, to develop the software, but that is not being used for business purpose. Like if you are doing your business, you are using your logo. That logo is being used for business purpose. This is not intellectual property that you are selling into the market. The loss is basically from you need to do the research, you need to invest into the research. After doing the research, you need to develop the intellectual property. From the intellectual property, you are selling the intellectual property. From the sale of the intellectual property, you are taking consideration. If you are doing all these things, then they said it will qualify as intellectual property. Then based upon this criteria, if this intellectual property is properly registered under the UE law or under any international law, from this consideration is being generated, then it will be considered as a qualifying intellectual property. From the qualifying, if this qualifying intellectual property is generating any income, some portion of the income based upon the formula will be considered qualifying income, other will be considered non-qualifying income. But important thing is that if you are buying any intellectual property and generating income, or if you are developing the intellectual property but you are outsourcing the activities to any party out of the UAE, which is your related party, then it will not fall as a qualifying intellectual property and you will not be able to generate, you will not be able to enjoy the relief of qualifying income. They have written basically objective. We need to try to understand the essence behind this. Essence is you need to do R&D. While doing the R&D, you can outsource activities, SIGA, core income generating activities within the free zone, within the UAE, or any other party which is not your related party out of the UAE. The product that you are developing, from that product, you are generating consideration. Then you can, your income, there is a possibility based upon the formula income will be qualifying income. If you are buying the intellectual property, generating income, no, this is not a qualifying intellectual property. Or if you are developing a intellectual property, but you are outsourcing the activities to any other person which is out of the UAE, your related party, then it will not be your qualifying intellectual property. They have given this. If a qualifying free zone person acquires qualifying intellectual property or also the R&D to a related party outside the UAE, the portion of the income that is attributable to the acquisition cost does not give rise to a qualifying income, which is important. You need to try to understand the essence behind the transaction. Essence is government wanted you to invest in the R&D to develop the intellectual property. So based upon this, we know what is intellectual property. These are the intangible assets that are not being used for business purposes. And from this intellectual property, it can be patent, copyrighted software, and these are they are given the definition 92 marketing related intellectual property as such a trademark. We have already discussed you cannot use, if you are using a trademark for business purposes, it cannot become your intellectual property that will generate the qualifying income. So income must be derived from the intellectual property. Yes, this is the consideration. You have developed the software, you are selling it, from that you are generating the income. And once you are generating the income, this is a qualifying intellectual property. If this is a qualifying intellectual property, from that property, you are generating the income. Income can be in the, you are granting the rights, basically, you are selling the software. From there, you are generating the income, and you need to apply this formula basically to calculate the qualifying income of the qualifying intellectual property. They're asking qualifying expenditure, basically R&D, research and development expenditures directly or indirectly ancillary to the development of the intellectual property plus uplift. This is asking that 30% you need to uplift the qualifying expenditure, but this qualifying expenditure plus uplift, it should not be more than the total expenditure of the qualifying intellectual property divided by the overall expenditure into overall income of the qualifying intellectual property. So R&D plus uplift divided by overall expenditures of the qualifying intellectual property multiply the overall income of the qualifying intellectual property. Whatever is the portion of income, that portion of the income will be qualifying income, and remaining will be straightforward subject to tax at 9%. You can go through this. They have given the example. I have told you the crux, basically what is the reason and how can you calculate the qualifying income of the qualifying intellectual property. You need to have the tracking system. This, what are the expenditure you are incurring? You need to have the tracking system. Okay. Now, qualifying activities. Qualifying activities, manufacturing. There no change. Important thing is they said end to end. Basically, all confusions has been resolved. Basically, if you are planning, designing, manufacturing, distribution, any ancillary activity, it will fall under the manufacturing. Same for processing. Same for the trading. They said you can go through this. Keeping in the time, we already spent around 1 hour. We need to finish just within 15 minutes. I think we need to have one more session on this. Okay. Manufacturing of goods or services. In the manufacturing, of goods and services, creation, production, improvement, end to end, conception of a product to the end to end. If you can the qualifying activity, they include planning as well, production, quality control, ancillary activities, post-sale activities, which are basically compulsory related to the product. It will be considered manufacturing as well. You can go through this. Make sure it doesn't repair. It will not be part of this. You can go through this. It is very straightforward thing. Meaning of the good they have defined, it will be physical good. It can be hardware as well, which is including the software, but software will not be part of the goods. Types of manufacturing, it can be two types. It will be contract manufacturing, toll manufacturing. I can get by contract manufacturing. Basically, contractor is buying, signing the contract with the customer. They are giving the manufacturer. Manufacturer is buying the material, giving and finalizing the product and giving to the contractor, and contractor is giving to the customer. Here, manufacturer is buying the material and finalizing the product. This is called contract manufacturing. Toll manufacturing is this contractor who has already signed contract with the customer. This toll manufacturer is giving design, material, everything to the manufacturer. Manufacturer is just finalizing the product as per the discussions with the contractor. Contractor is taking the product and giving it to the customer. Full-fledged manufacturing means this manufacturer is buying the material, taking risk, finalizing the product and selling it. In all these cases, even this is the contract manufacturing, even this is the toll manufacturing, even this is the full-fledged manufacturing. If the manufacturer, which is based within the free zone, is performing manufacturing activity for any customer in the UAE, out of the UAE, in the mainland, it doesn't matter. This will fall under the qualifying activity. It will generate qualifying income, provided all other conditions like adequate substance is being maintained and de minimis, all those criteria is being met. They have mentioned in the, you can go through this. I have already told you. Then processing of goods and material, you can go through this. This is end to end. Trading of qualifying commodities. This was another area where we were looking for some sort of clarification. Question was basically these commodities, if these are being traded only through the electronic mode, like there are different exchanges across the globe, and from the exchanges you can buy and sell from the commodity exchange, you can buy or sell the commodity. Only the commodity that is being bought or sold from the exchanges, that will fall under the qualifying commodity, or if the transaction is being made out of the exchange, will it fall under the qualifying commodity? They have clarified it, and they have clarified basically it doesn't matter you are making transaction through the exchange. It doesn't matter you are making transaction out of the exchange. Important thing is you are trading the qualifying commodity. You are buying and selling the qualifying commodity. And the qualifying commodity that define this is a raw commodity with 99% purity, but some function initially you can perform to convert the quality into the qualifying commodity. That commodity will, if the buying and selling of the qualifying commodity, it will be considered a qualifying activity as well. There, the trade itself does not need to be performed through an exchange. This is the important thing I have highlighted. It's not basically out of the exchange, through the exchange. Important thing is you are buying and you are selling qualifying commodity, which is 99% purity in bullion form. Just to give an example of gold. In the same way, you can look at the various examples like raw gold can be there, raw material can be there, cotton can be there, HSN code be there, upgrade mineral. This is minor tweaking can be there, minor processing will be there. Basically, if you are taking the cotton and you are segregating through ginning process, you are taking the seed and the cotton separately, and then cotton will be the final product. If you are buying and selling the cotton, that is the basically 99% purity in raw commodity. This is the commodity. They have defined the commodity. The qualifying activity, buying and selling, ancillary activities, warehousing and delivery. If this is the compulsory, then this will be considered as a ancillary activity. All these activity will be considered a qualifying activity. and it will generate 0% qualifying income provided all other conditions are being met. Holding of share and security, this is the same thing. You are not trading, buying and selling the share, but you are holding the share at least for a period of 12 months. Objective is holding of shares and other security for investment purposes, and they have defined a timeline of 12 months. It was given in the already cabinet decision as well. There's no change for regarding this. You can go through this, there's no change. Jumping quickly to the rest. Ownership, management, operation of ships, I think there's no change. If the company, the free zone person ownership, managing or operating the ships, and these ships are being operated in the international water, and these are not being used within the UAE, and the activity does not include ships used for local transportation, leisure, recreational services, then it will be qualifying activity. Otherwise, it will be a non-qualifying activity. It doesn't matter what is the power and tonnage of the ship, it doesn't matter. Reinsurance services. This is very straightforward. Reinsurance services are qualifying activities. Insurance services are non-qualifying excluded activities. These are the qualifying activities. SIGA, core income generating activities of the reinsurance services. They have given example as you can go through this. This is the basically primary insurer. This is the reinsurer. Reinsurance services to the primary insurer, qualifying activity. This primary insurance services to the insured person, non-qualifying activity, excluded activities. Fund management, wealth management services provided, it will fall to the free zone person, non-free zone person will fall under the qualifying activity. They have given nothing unusual. You can go for this, very straightforward. Wealth management, a broader aspect. One aspect of the wealth management is fund management. Wealth management includes everything, starting from basically you can give them health, you can give them retirement plan, you can give them wealth management, everything you are providing to any person, like fund and wealth management services, that will be entire basically encompasses all parts of the person financial life. So it will fall under the qualifying activities, the portfolio management, financial, all three. You can, nothing unusual. They are given example as headquarter services to related party. If any headquarter services are being provided to the related party where the headquarter is responsible for the performance and success of the related party, then it will fall under the qualifying activity. They have given providing sport, a different type of sport like administering, overseeing, management, captive insurance, administrative planning, risk management, HR management, all these services will be considered under the qualifying activity. At the end, head of the responsible for the overall group's success and performance. These are the strategies. These are the qualifying activities, what they will be doing. These are ancillary activities. These are the examples. You can go through this. Leasing of aircraft, I think nothing is unusual. If you are financing a leasing of aircraft to any person in the free zone, out of the free zone, it will fall under the qualifying activity. Here you can look into the example, leasing services. This bank is free zone. Free zone person is providing these services to the income from the excluded activity because their leasing is excluded activity. Leasing is itself excluded activity, but if this lessor is providing company, this is a qualifying activity, operating or finance lease to the, it will be qualifying activity. Okay, our favorite distribution business. I'll quickly go through this. Distribution. Now, I have already told you distribution business. The only one thing we were looking for basically, if the goods are not entering into the UAE, goods are moving from one country to the other country, third port sale, will it be considered qualifying activity or not? This was the question that everybody was asking. I had already the same point of view because in the public consultation paper, they have given third port sale is a qualifying activity. In the decision, I think 265 cabinet decision, ministerial decision, they said if may, they use the word may. I had already the same point of view that it will be considered as a qualifying activity. Now, through the example, they have defined it. They said if the goods are moving, third port sale, it will be considered qualifying activity provided the qualifying free zone person is based within the designated zone and all other requirements are being met. They have given in this example. They have copied the example, by the way, by the public consultation paper. Goods are moving, manufacturers in A, country B. Goods are moving from one country to other country. This company is in the designated zone, which is very important. You should be in the designated zone. If you are not in the designated zone, you are sitting out of the designated zone, then you will not be able to enjoy the 0% qualifying income relief on the distribution business. You must be in the designated zone, and you need to maintain the adequate requirement, adequate substance, all other conditions of being qualifying free zone person. Then it will be a qualifying income. In the same way, if the goods are coming from the country A, the goods are coming within the designated zone. From the designated zone, goods are being cleared through the designated zone on the mainland, then it will be considered qualifying activity as well. See, goods are coming from country A to the UAE. From UAE, the goods are coming to the UAE mainland, but these goods have been cleared to the designated zone. Then it will be considered that the person has met the qualifying income criteria. In the third example, you can see the goods are from the UAE. The goods are moving from the UAE to the country A anywhere. Goods are already in the UAE. It might be in the UAE mainland. Goods are already in the UAE mainland, and these goods are now moving to any other country out of the UAE. Important thing is this free zone person must be based in the designated zone. But the goods can move out of the designated zone, still it will fall as a qualifying income. Third category is goods are in the UAE and moving within the UAE. The person must be based within the designated zone. Even the goods are moving from the mainland to the mainland, mainland to the free zone to the mainland, it doesn't matter. The person must be in the designated zone, so it will be still considered a qualifying income. The summary is first, the person must be based in the qualifying free, in the free zone. The person must be based in the designated zone. Then the person must be meeting all the conditions of the person becoming a designated zone. Then, the person must be based within the designated zone. The person must be meeting the designated zone requirement criteria. Now the movement of the goods. If the goods are coming in the UAE, it should come through the designated zone. Otherwise, there is no requirement for the goods to come in the designated zone. All other activities will be considered qualifying income. It will generate 0% corporate tax, provided all other conditions are being met. I'm repeating. The person must be based within the designated zone. Person must be a qualifying free zone person. All other conditions are being met. Only one requirement is there, the goods needs to come in the designated zone. If the goods are being imported, it needs to come in the designated zone. Then from the designated zone, it needs to clear and go on the mainland. Otherwise, there is no requirement for the goods to come in the designated zone. Still, it will be considered qualifying income provided person is based in the designated zone. So logistic services, this is transportation, this end-to-end logistic services, it will be qualifying activity. If anyone is providing individual, this all qualifying activity, important thing which is, if anyone is providing assessing a single activity, might be that activity is not a qualifying income, but end-to-end, it will be considered qualifying income. We need to always look into this, which is very important thing. So if any one possibility, the one company is providing only cargo handling, it will be subject to tax. If one company is providing only warehousing, it will be subject to tax. One company only storage, it will be subject to tax. But there is a one company that is providing logistic services. The same company is providing cargo handling, warehousing, storage, agency services, brokerage services, everything end to end. Then all these activities will be considered ancillary activity. It will be subject to tax at 0%. These are qualifying activity. You can go through this. These are ancillary activity. You can go through this. They have given the example. They said last mile delivery. Last mile delivery, if provided by the individual separate party which is not providing the logistic services, it will be subject to tax. But if this last mile delivery is being provided by the same company which is providing logistic services, then it will part of the qualifying activity they have mentioned here. You can go through this. Excluded activities. There are no change in the excluded activities. As we discussed, if you are supplying to a natural person, it will be subject to tax except these. Banking activities are excluded activities. Insurance are excluded activities except reinsurance and capital insurance. Finance and leasing are the excluded activities except financing and this operation ship management, ships related party, aircraft, immovable property. All ancillary activity treatment is same. At the end, I just like to say transaction with a natural person leasing of the aircraft, You can go through this. Leasing, they have given the compliance requirement, you need to maintain the record. State source income, they're not liable to register for corporate tax. Application of standards, preparation of financial statement, I've already told you. Audit is compulsory. Whatever the accounting policies are applying, it depends upon the revenue. Thank you. Thank you very much. Thank you from my side. Let me go through your question quickly. The few questions. Are the DMCC and Rockies are designated zone? You can go to the list of a designated zone. It has been given in the guide. If you are not in the list, you need to ask from the respective authority. I believe this designated zone, as this is as per the UE VAT law. VAT law says the designated zone basically custom controlled area. DMCC is not a custom controlled area. It will not fall under the under designated zone. Rockies, for the Rockies, uh, I believe this is a custom controlled area, but still you need to check from the respective tax authority. Christopher is asking regarding example 75 from the affiliate guide pertaining to the tri-area finance sector related party. Do you see that an issue with the investing surplus group capital into the local foreign related entity? You can, this is a very long question. You can go through. I can tell you very quickly. The cash pooling, investing surplus, they have given very clearly for the investing surplus that it will not be considered as your qualifying income, but cash pooling to generate the income, it will consider qualifying income. You can drop me a message or you can drop me an email. I will be happy to discuss with you on one-to-one basis, because this is long questions and answer will be long as well. But apparently, as I mentioned in the guide, they have given if you have a surplus funds, and this will not be qualifying income. But if you are doing cash pooling with the intention to make the profit, intentionally to reallocate the funds within the related party, then it will be. Is marine fuel which has exchanged and traded on exchange will be considered as a trading commodity under the, they have given a list of the trading commodity. I think marine fuel is not part of the trading commodity. They're asking 99% purity. And 99% purity, where we need the product, we need to tweak the product. Slight tweaking should be there. Again, we need to assess on case by case basis. First of all, we need to establish, is this a raw commodity 99% purity? Then it will fall under the qualifying commodity. Otherwise, it will not fall under the qualifying commodity. So no more question. Okay, a few more questions are there as well. Jobs are offshore entities that hold shares or property that do not have a UE trade license required to register for the, yes, you need to register for sure they, because only the exempt entities they, and the person, individual person having a income up to 1 million, they are not liable to register, because otherwise jobs are offshore entities hold shares, they need to register and they need to claim exemption, because it will fall under the holding for investment, it will be zero rated. Hasib is an offshore company. Jobs is earning royalties income from the mainland company. It do not have any license to do any activity. Will it, its income taxable, or how it can register for the city if there is no license? Based upon the incorporation certificate, you need to go and apply for registration, because if you are asking overall, there are no demarcation from where the entity is being controlled and managed. Law says it doesn't matter. Even the entity is within the jobs, even the entity is out of the UAE. If this entity is being controlled and managed from the UAE, you will become a resident person and registration will be compulsory. Sharma is asking, what should non-designated zone companies do, as third part transaction are same for both designated and non-designated free zone companies? I agree. Third port transactions are same for the designated and non-designated zone company, but the law requires, if you want to enjoy the benefits from the distribution business, you must be a designated person. You must be have adequate substance within a designated zone. You need to follow the all criteria. Then only you will be enjoy the qualifying income relief 0%. Otherwise, you will not be able to. Mohan is asking, my company in Jafza, we want to register. Yes, you need to go for registration. As I told you, only the four categories in the exam, like government entities, government controlled entities, companies involved in the extraction of natural resources, company involved in the sports service extraction of non-extractive natural resource businesses, or the individuals having natural persons sole establishment income up to 1 million, they are not liable to register. Other than this, every company within the UAE is liable to register for corporate tax. Some entities need to apply for deregistration, and some entities even they can't apply for deregistration, they are liable to comply the requirement of the corporate tax as well. So it is mandatory to register CT for jobs offshore companies which doesn't have adequate substance. You need to register, as I mentioned, this is the same question coming again and again. All you need to register, it doesn't matter the exempt categories I have already told you. Even the company is in USA, management is based in the UAE. Still, that company is liable to register for corporate tax. The law says from where you are controlled and managed. This is very important. Basically, your residency status will be based upon the control and management. Okay, guys, thank you very much. Thank you very much for being with us today. And still, if you have any question, you can drop me an email. I'll come back to you. Our team will come back to you. Thank you very much, Faiza. Thank you very much, everyone, for being with us, and have a lovely evening. Thank you. Bye bye.